Hi, this is Eric Schleien. You are listening to the Intelligent Investing Podcast, the ultimate resource for sophisticated investors seeking unparalleled depth and investment analysis. I am your host, Eric Schleien, and today we are taking a comprehensive journey into what I believe is one of the most intriguing and misunderstood opportunities in the UK housing market today, Vistry Group. I'm not going to just do a quick overview for this episode. I really want to make this the definitive guide to understanding Vistry from its strategic transformation to the broader market dynamics impacting its performance. And by the end of the episode, my commitment is you're going to have a deeper grasp of Vistry's investment thesis than most institutional analysts. So grab your coffee, settle in, grab a cigar, have a whiskey. We're diving deep. To begin, let's rewind to the genesis of my investment in Vistry. At the heart of this story is transformation, specifically Vistry's pivot from a hybrid traditional and partnership home builder to a pure play partnership model. And this was not just a strategic shift, it was also a paradigm shift that fundamentally altered the company's risk profile, growth profile, and valuation framework. Also, before I continue, I just want to make it clear that nothing in this podcast is investment advice. Consult a financial advisor for investment advice, and nothing in this podcast should be taken as an offer to buy or sell any kind of security. With that out of the way, do your own due diligence, and I will continue. So the UK housing market also has long suffered from a chronic undersupply, with demand far outstripping the available stock. Estimates suggest a shortfall of over 1 million homes, and this backdrop creates pretty fertile ground for companies like Vistry that are strategically positioned to deliver affordable housing. But what I really believe sets Vistry apart is the partnership model. So in essence, the company collaborates with local authorities, housing associations, and government bodies to pre-sell homes before construction begins. This capital light approach significantly reduces the risks associated with speculative home building, such as unsold inventory and volatile cash flows. Over 50% of Vistry's developments are pre-sold, providing stability and visibility into future earnings. Financially, the model is a powerhouse. Projects are expected to generate returns on invested capital, which we refer to as ROIC, of 40% or even higher. And you compare this to traditional home building companies, which typically are in the range of 15 to 20%. At the time of my initial investment, the market was valuing Vistry as if it was still a traditional home builder. The shares were trading around the 700 to 800 pence range, and my base case valuation pegged the fair value significantly higher than that, probably more in the 3 to 5,000 pence range. So I saw significant upside potential in the company, assuming the company executed its transformation effectively. For some context, and I'm going to give the disclaimer, this is loose context. There is a Value Investors Club write-up that came out about this maybe about a year ago or so that talks about this. I don't fully agree with that, but I'd say it's a loose context. They make it sound like it's a very strong context. But for some context, if you look at the U.S. home builder NVR, which I also, full disclosure, do own shares in, NVR operates a somewhat similar capital light model. I think the similarities end after that, but the main similarity is the capital light model. And over the past 3 decades, if you're familiar with NVR, they've repurchased more than 3/4 of its shares while compounding earnings at a pretty inevitable rate. And my thesis was that Vistry could follow somewhat of a similar trajectory. If you fast forward today, it's very fair to say that Vistry's journey hasn't been without its hurdles. So let's unpack the key challenges the company has faced. There's been tons of profit warnings. So when I say tons, 3. In the span of a single quarter, I'm recording this December 30th, 2024. They've had 3 profit warnings, and that's reduced its 2024 adjusted operating earnings forecast from about £300 million down to 250 million pounds. The announcements also revealed a sharp increase in expected net debt, which is now projected to reach about 200 million by year end, compared to the net cash position initially forecasted. The UK's interest rate environment has also shifted dramatically, with the 10-year gilt yields climbing from under 1% in 2021 to just around over 4.5% today. And that's created significant headwinds for BTR projects. BTR stands for build to rent, for those not familiar. And that's a key segment of Vistry's business. BTR competes directly with fixed income instruments for institutional capital, making it less attractive in high rate environments. There's also been housing association struggles. So housing associations, for those not familiar, these are critical partners in Vistry's partnership model, and they've been under some financial strain. There's been rising refinancing costs, coupled regulatory mandates for fire safety and energy efficiency upgrades. I forget exactly when it was, but during this past year, the UK government's approach to affordable housing, you could say, has been somewhat inconsistent. There's been delays in subsidy announcements and shifting policy priorities. Additionally, there's what's called the CMA, which stands for the Competition and Markets Authority. They launched an investigation into the home building sector, which did include Vistry as one of the companies mentioned. And it was to examine issues like land banking and pricing practices. My view, and I could certainly be proved wrong by that I do think the investigation is probably unlikely to yield any kind of severe penalties, but it certainly does add a layer of uncertainty. I think it's probably good I don't want to get too into this, but to get a little historical context of the UK home building industry. I think to fully understand Vistry's position, just want to step back a little bit and examine the historical context of the UK housing market. The UK's housing crisis is not a new phenomenon. If you go to the Financial Times website, Wall Street Journal, and you look this up, there's articles going back years. It is the result of decades of underinvestment and very restrictive, and that is not hyperbolic, very restrictive planning regulations and also demographic shifts. So if you go back all the way to World War II, the UK experienced a housing boom, which was driven by government initiatives to rebuild war-torn cities. And if you fast forward to around the 1980s, it marked a turning point with the introduction of the right to buy scheme. The right to buy scheme allowed council tenants to purchase their homes at a discount. And while this policy expanded home ownership, it also depleted the stock of social housing with adequate replacement. And this sort of leads into the UK's planning system. The planning system in the United Kingdom has long been criticized for its inefficiency. And as someone who is a pretty hardcore libertarian, I'd say rightly, the Town and Country Planning Act of 1947 established a centralized approach. But over time, it's become increasingly bureaucratic. No shit. Developers face long lead times, significant costs to secure planning permissions, and predictably, this has constrained supply. So if you look at recent years, there's been a whole slew of regulatory changes. One of them is there's been quite a bit of fire safety reforms. So following what was called the Grenfell Tower tragedy, the government introduced stringent fire safety requirements. And for developers like Vistry, this has meant higher costs and project timelines that have been longer. There's also energy efficiency standards. So there's been a pretty strong push for net zero emissions, which has led to new regulations requiring energy efficient building designs. And while these standards are, you could say, necessary, they've also significantly increased construction costs. There's also affordable housing targets. So local authorities are mandated to include affordable housing quotas in new developments, further complicating project economics. But I do want to turn a little bit to the numbers and dissect Vistry's financials to better understand its current position and also future potential, which is really what matters to valuing the business. So even if what can only be described as a challenging year for 2024, the company's trading probably around 10 times earnings for 24. That valuation's pretty low, particularly for a company transitioning to a capital light model, which you should see a higher valuation on earnings or free cash flow. Traditional UK home builders typically trade between the 1 to 2 times tangible net asset value. Yet Vistry, at the time of this podcast, is trading at about 85 cents on the dollar of a tangible net asset value. And that's with lower risk partnership model, which you could argue should trade at a higher premium to tangible book value. Also being said, the land on its books currently is at cost. When that goes to the market, that should sell for above book value. So I would say that the true book value is actually probably lower than 85 cents on the dollar. And the company has said they're most likely going to be buying back more stock heavily in 2025. So I'm crossing my fingers for that and hoping the stock price stays low to take advantage of that. The tangible assets are around $2 billion today, which is just comprised of cash, receivables, inventory, and some investments in some joint ventures. The liability side includes the rising net debt, which is well covered. So I'd say you have a pretty robust margin of safety on the balance sheet side. The company's net debt position, while higher than initially anticipated, does remain extremely manageable relative to its asset base and current and future cash flow generation. This is a growth story, and I think it's always good to be skeptical of growth. One thing that the partnership business does have going for it is that the costs are pretty predictable. The company has a long-term goal to complete 30,000 partnership homes annually, and that's up from around the current 18,000. If achieved, which I think is extremely doable, the expansion would effectively double the company's earnings capacity. And additionally, share buybacks, as I said earlier, remain a key component of the capital allocation strategy, further enhancing shareholder value. One thing also to be said, I'm going to go into some valuation in a little bit, is you have a doubling of the company's earnings capacity, and they really prove out their partnership model. And you basically don't have 2025 look like 24, where you have a little bit more smooth sailing, which ideally is what the partnership model should be. Some of these cost overruns, actually all these cost overrun issues of this year have been based off their legacy business, not their partnership business. But the UK has a interesting investment climate where people tend to be extremely cynical and for good reason. But analysts are even more so about, I'll believe it when I see it. So just when the market was getting bullish on Vistry, you had all these cost overrun issues and press release after press release 3 times over in just a few months that caused the stock to plummet. And I don't think the stock would have plummeted as much if this was a United States company. But in UK, it confirmed that cynicism. I think long term that actually ends up being a benefit to Vistry to buy back stock at much lower prices at valuations of 85 cents of tangible book value, which I've already said I think is understated to begin with. You fast forward a year or a few years, and you have companies' earnings that are going to double their capacity. I think you're also going to see valuation expansion as well, so you get this double whammy. So I'm going to go into valuation, and I say is actually just conservative. My true valuation is actually significantly higher than that, especially if you go out the next 10 years. It's weird to talk about because I don't really think it's that useful an exercise to talk about a 10-year valuation. But I do think it's useful to stress test the downside. So if we use conservative assumptions, I do assume that Vistry's 2024 net income ends up a little over 100 million, so call it 130 and change or something, factoring the elevated cost and also a slower recovery in private sales. Even under these pessimistic conditions, the stock is still trading at a pretty modest multiple with significant upside if the business normalizes, in my perspective. Again, do your own due diligence. A few other just little thoughts I'll add to this. I do see their long-term debt as a stabilizer. While rising rates, you could say, have pressured the housing associations, the long-term debt structures mean that the impact is actually pretty gradual, and I think this could create a more stable environment for partnerships over maybe the short term, but I'd say certainly over the medium term. And I think that actually ends up being a good thing for Vistry. Also the regulatory tailwinds, I think, is important to look at as well. Despite the short-term costs, I went into earlier about how there's been stricter fire safety and energy efficiency standards. I think that actually ends up acting as a moat for established players like Vistry, where you end up having a sort of a deeper level of corporatism than there already is, deterring new entrants. Again, the free market side of me is like, that's stupid. But again, I can hope for the world that I want, or I can deal with the way the world is. And on a purely free market, I wouldn't even be talking to you about Vistry, but UK is so far removed from that. I don't think they're going to be there anytime soon. So you end up having a pretty high moat, I think, for Vistry based off their relationships both with housing associations and then also these regulatory tailwinds as well, which, again, increase short-term costs, but I think long-term is very good for the business. There's also, you could say, institutional capital shifts. So as interest rates stabilize, you're probably going to see institutional investors likely reallocate capital to build-to-rent projects. And that obviously becomes a major tailwind for the BTR segment of Vistry, which is a pretty large component of their business. This past year and a half or so with Vistry, it's been quite a humbling and educational experience, and I think it reinforces several critical lessons for value investors. Number one, patience is a virtue. Investing is, especially in these transformative businesses, often, if not almost always, require enduring some level of short-term pain for long-term gain. If it was all beautiful and smooth sailing, you would not have these opportunities. So there tends to be always some kind of hair, some kind of thing going on to take advantage of market inefficiency. And I think in this case, the market's fixation on quarterly results has created quite an enormous opportunity for investors willing to be patient and see beyond just a few months. This also goes to the second point, which Warren Buffett always talks about, is know your circle of competence. While I have deepened my understanding of the UK housing market to, you could say, somewhat of a disgusting level, the experience highlights the importance of thorough industry research and staying within one circle of competence. If you're just buying Vistry because you heard this on a podcast or you read some article, but you don't learn anything about the UK housing market, and then you experience this, a stock crashing by 50%, do you buy more? Do you sell? Do you freak out? This is exactly why understanding what you own is so important. And then the third thing, which is so important, not only investing, but also in life, which I think a lot of these investing principles end up working on in life as well, is focusing on the process, not the outcomes. I cannot stress that enough. Short-term price movements are often noise. They usually are noise. And staying grounded in the underlying thesis is critical to achieving long-term success. Now, that being said, if your thesis is broken, which in this case, when there was cost overruns, my first thing is my thesis broken. Let me talk to people that think it is, right? It's looking to actually always try to break your thesis, not to just constantly confirm how you already feel or believe. I think being able to admit mistakes is one of the best traits you can have as an investor. And I think the bull case, which I actually think ends up being the likely case, is you end up having this sort of continued structural demand for years to come. The UK's housing shortage is going to remain a powerful tailwind. I don't even think that's debatable. I think that's a given. Mathematically, I don't see how you get rid of that unless they go full on Argentina or something, which I'd say is as close to 0% as it gets. But I think that's going to ensure long-term demand for affordable housing for years to come. I think I read an article a few months ago. They were like, if everything went perfect, it would take like 20 years to fix the supply and demand imbalance. So whether that's exactly true or not, I'm not sure, but it's going to be years of affordable housing demand. The partnership model, shift to a capital-light model, certainly reduces risk and enhances returns on invested capital. Now, I say certainly with implication that the partnership model works, right? If this model is busted, right, you end up having, you could say, greater risk where you cannot afford to be having cost overruns that are even 10, 15% in a partnership model, right? Because you're exchanging lower margins for significantly higher returns on capital. Now, my perspective is, if you look at these cost overruns the last few months, they were all from they were from the legacy business, and they were overseen by managers from the legacy business, which, by the way, those are all gone now. All the management team is pure partnership now, and the CEO is directly involved in overseeing those projects now because he wanted to be completely on top of it. The thing to acknowledge is, in the sort of traditional home building business, there is more wiggle room to be a little bit off, but your margins are higher. Now you're exchanging higher margins for lower returns on capital. So in this case, those issues were to, I guess, extend to the partnership business, which you could say the market is betting on. And I think that's a significantly low risk. I don't think it's zero, but I think if I had a bet, I'd say it's like a 5% chance, 10% chance at the most. I'm willing to bet a lot of money on that it's not going to happen. If it doesn't happen, yes, the capital light model significantly reduces risk. It reduces the economic cycle risk. It reduces interest rate risk. It gives you a much more predictable business model that, of course, enhances return on invested capital. And as long as they don't incinerate that capital, which they're clearly not, it ends up becoming a higher investment rate of return for shareholders. The growth targets as well, I mean, they do have a pretty ambitious goal of 30,000 partnership completions annually, and that obviously would significantly boost earnings. Now, this is all, again, in the context that the partnership model is not flawed and not broken. And then the valuation gap. So I think the stock right now, the current multiple on the stock just fails to reflect its growth potential. Right now, it is literally being priced below liquidation value. So you end up having substantial upside, both based off growth and then based off a higher valuation on those higher numbers. So you get a double whammy. Now, of course, the bear case, I think it's obvious, right? The regulatory risk. So you have delayed subsidies, shifting policy priorities, and that can weigh on, I'd say more likely just weighs on near-term performance. I still think it's so unlikely you end up having regulatory policies that shift away from home building. If you are in government in the UK, this is just a big talking point. It's not really that debatable. There's a need for it. And now you could say the other side is just free up the markets completely, get rid of all the housing associations, have a completely free market. That's not going to, there's a 0% chance that's going to happen, right? Again, UK is not becoming Argentina tomorrow. As long as that happens, as long as UK is not Argentina, there's no issue here. Side note, in Argentina, they have gotten rid of a lot of the affordable housing. And of course, housing prices have gone down quite a bit, and it's been good for poor people. But that's another topic for another day. Also, I guess you could say there's interest rate sensitivity, right? So if we have prolonged high rates, let's say interest rates go back up in the UK and they stay high, that certainly could dampen demand for the build-to-rent projects and strain the housing associations if that was long-term, which I don't think is out of the question. I think that's actually probably the biggest risk, is just you have some hyperinflation scenario and you have 15% interest rates. That would be a disaster for all home building. Execution risk, the transition to a pure play partnership model, it does require pretty flawless execution. There's not a lot of room for errors. So if the partnership model is busted, then this entire podcast is not worth anything. And I'd say I still don't think you lose money. This is what's interesting, right? If their partnership model, it goes to shit, and they just go back to their legacy business and just become this normal home building company again, you still are buying a stock today at less than 85 cents on the dollar of tangible book value, right? And I say less because I think that balance sheet is understated. So you would still, I think, probably do like high single-digit returns in a really horrible scenario from here. So even just using a very conservative approach to this, I would model Vistry's fair value somewhere in the range, I'd say on the very low end, which would, in my view, be a disaster. It's worth like 12 pounds a share. I think more likely it's closer to 18 to 20 pounds a share in a conservative approach, right? And this is, as I'm talking, I think the shares are like 550 pence or something like that. So this valuation would incorporate adjusted earnings power of about 250 million and change annually, and that's going to normalized environment. You have that tangible net asset value of 2 bill as a floor for downside protection. And those are my views. Those are my thoughts. I think it's something I like because I think in this case, the variant view that the market is taking, I think is a very low probability. It would be one thing if they had come up with some cost overrun issues and said, we have some issues in our new partnership business. This would be a different podcast. That would be a different conversation. But all of the issues have been in the legacy business. Now, there were a few things recently that were reported regarding at the minute some of the projects ended up not having the returns on capital they wanted, and they walked away from it. They still hold land. They can develop it. They can turn it into partnership models. There's other things they can do with that real estate. But these have all been issues around their legacy business. Their partnership business, and there's been pretty much no change in their partnership business over the next 5 years based off the recent news. But the stock price would say otherwise. So maybe we'll come back in a year, do a little review going into 2026. But that's it. I appreciate you joining me on this deep dive into Vistry. And if you found this analysis valuable, please share it with your friends, your network, or reach out to me with your thoughts. You can shoot me an email, intelligentinvesting@gmail.com. You can also reach me on Twitter at Eric Schleien. I am also on Instagram. My Instagram name is Lone Star Blaze, and you can reach me on there as well. Until next time, stay curious, stay patient, keep investing with conviction, but don't be afraid to admit your mistakes. Happy New Year.